Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Tuesday, June 9, 2026. We're Elena and Marcus.
And if you are looking at your portfolio today, you might be, well, highly confused.
Yeah, just a bit.
Right, because you might be wondering why bond investors are acting like it is a perfectly sunny day, seeking safety in treasuries, while at the exact same time, options traders are aggressively boarding up their windows for an economic hurricane.
Yeah, today's data deck reveals a market caught in this massive web of colliding forces. To help you navigate this, we are tracking 4 critical themes that define the session.
First up is the violent equity rotation.
Right, mega-cap technology and AI are experiencing a severe positioning flush. But if you look beneath the surface, the broader market breadth is actually quite positive.
And second, we have the macro rates tug of war.
Yeah, a tactical flight to quality is pushing Treasury yields down today, even as the options market is, heavily pricing in imminent Federal Reserve rate hikes.
Which brings us to the third theme, geopolitical whiplash in energy.
WTI crude swung wildly today, from demand destruction sell-offs to a really sharp after-hours rebound following U.S. airstrikes in Iran.
And fourth, the credit divergence. This is our synthesis for the day. High-yield corporate bonds are pretty much completely ignoring the equity panic.
Exactly, which signals a valuation correction in tech rather than, an impending global recession.
Moving to today's data, we must unpack the primary macro drivers, starting with the yield curve and how it's behaving both domestically and internationally.
Right, because for you as an investor, the yield curve is really the foundational baseline for how every other asset is priced.
Precisely. And domestically, our daily desk data shows a clear drop today. The U.S. 10-year Treasury yield fell roughly 4.5 basis points.
So landing right around 4.52%.
Yeah, exactly. And we saw a mirrored move at the front end of the curve, too, with the 2-year yield also dropping about 4.5 basis points to 4.13%.
And the longer duration 30-year yield dropped nearly 4 basis points to just over 5%.
Right. But we also tracked some significant movement in international rates, which, as we know, directly impact the global flow of capital.
According to our latest run, the Bank of Japan is actively discussing slowing their bond purchase reduction.
Yeah, they're reviewing the program to extend all the way into fiscal 2027.
Which marks a notable dovish lean, right? It essentially eases pressure on the 10-year Japanese government bond.
It does. But then, on the exact opposite side of the spectrum, Bank Indonesia delivered a surprise 25 basis point rate hike,
bringing their policy rate to 5.5%. And they did this explicitly to halt capital outflows that were triggered by policy uncertainty.
Yeah, the dynamic in Indonesia perfectly highlights the immense pressure that divergent global rate paths place on emerging markets.
Because when major economies keep rates high,
capital naturally flows out of emerging markets seeking higher, safer yields.
Right.
Which forces those central banks to hike rates defensively, often, at the expense of their own domestic growth.
Yeah, and furthermore, our daily desk data notes that Bank of France Governor Emmanuel Moulin confirmed the central bank will revise its 2026 inflation forecast significantly higher.
Primarily due to the ongoing war in Iran.
Exactly. Which brings us to a critical contradiction in today's proprietary updates. If Treasury yields drop today across the entire curve,
which indicates strong buying pressure driving bond prices up, yeah.
Right, then why is the SOFR options market aggressively pricing in 1 to 2 Federal Reserve rate hikes by September?
It's a great question.
For context, SOFR options are derivatives institutions use to hedge against future interest rate moves. Specifically, we are seeing massive volume in September 2026, put condors.
Yeah, and without getting bogged down in derivative jargon, a put condor in this context it's a highly leveraged structural bet by institutional traders that policy rates are going to spike.
So we have a bond rally occurring at the exact same time options traders are betting heavily on higher policy rates.
Right. How do you reconcile those two completely opposing signals?
To make sense of this, let's use this simple first principles analogy. It is basically like buying an umbrella on a perfectly sunny day, just because you see the barometric pressure dropping rapidly.
Okay, I like that.
The immediate drop in Treasury yields today is the sunny day. It is a purely tactical, short-term flight to safety.
Right. Market participants are watching the severe sell-off in high-flying technology stocks.
They are watching geopolitical escalation.
Yeah, and they are seeking the immediate, highly liquid shelter of U.S. government bonds.
And that wave of sudden demand drives the bond prices up and pushes the yields down.
Correct. The bond market today is reacting to immediate equity fear. It's really just a knee-jerk reaction. But the SOFR options market acts as the long-term weather forecast, and it sees a massive economic storm approaching.
Because the options market is reacting to underlying economic growth data, which is running extremely hot.
Yeah, the Atlanta Fed GDP Now tracker, which is a real-time estimate of economic growth, was just revised upward to a robust 3.29% for the second quarter.
Which vastly outpaces the broader institutional consensus of 2.2%.
Exactly. And furthermore, tomorrow's May Consumer Price Index reading is widely expected to breach the 4% mark.
So the economy is basically operating with intense stagflationary pressure. Growth is running hot, but inflation is stubbornly high.
Precisely. The options market is looking at that data and betting that the Fed, under newly installed Chair Kevin Warsh, will have no choice but to actively hike rates to cool this down.
And the spread between the current policy rate and the two-year yield mathematically confirms this tension.
Right. The two-year yield, sitting right around 4.13%, is roughly 38 to 58 basis points above the Fed's current policy band of 3.5 to 3.75%.
So the Treasury market is mechanically forcing an expectation of future hikes into the curve.
Yeah, our latest run shows institutions like BNP Paribas are now forecasting 3 back-to-back Fed hikes beginning December 2026.
While Goldman Sachs just pushed their first cut expectation all the way out to June 2027.
Understood. Connecting that hot economy and those hawkish rate expectations directly to the equity market explains the severe pain we are seeing in high multiple stocks.
Yeah, when the cost of capital stays higher for longer, companies trading at massive valuations based on future earnings get repriced aggressively.
And today's index performance outlines a massive, highly specific divergence. The S&P 500 closed down 0.26%, and the NASDAQ 100 closed down 1.12%.
But you have to look past the closing numbers. That NASDAQ close masks a violent 4% intraday plunge.
Right. That was the largest intraday swing in 3 years, outside of the April 2025 shock window.
Yet while the NASDAQ was plunging, the Dow Jones gained 0.1% and the Russell 2000 gained 0.41%.
Yeah, our daily desk data shows surprisingly good breadth across the broader market. You had 353 names in the S&P 500 actually trading in the green today.
In fact, the equal weight S&P index, which treats every company the same regardless of size, outperformed the cap-weighted index by nearly 1%.
Which proves this is not a broad market sell-off driven by systemic fear. It is a highly concentrated unwinding of extremely crowded, long positions in technology.
We can see this rotation clearly in the corporate movers. Supermicrocomputer, ticker SMCI, plummeted 12% after hours.
Because they announced a massive $7 billion equity offering.
Right. They need this capital to fund their AI server component inventory just to meet a $39 billion order backlog.
For you as an investor, understanding the mechanics of an equity offering is crucial here. When a company issues $7 billion in new stock, they are materially diluting the ownership stake of every existing shareholder.
And investors are aggressively punishing that dilution.
Yeah, they're punishing the immense cost required to simply maintain the company's growth rate in the AI space.
We also tracked Ericsson, ticker Erica, and Nokia, ticker NOK. Both dropped over 6% today amidst industry reports of NVIDIA entering the telecom chip space.
Which immediately threatens their market share.
Yeah. And Apple, ticker AAPL, also dropped 3.5% following its heavily anticipated developer event.
But the underlying data on Apple tells a very different story than the price action. Apple's strategic positioning here is highly nuanced and very smart.
Our proprietary updates show Apple is systematically abstracting AI to memory.
To put that simply, instead of relying on massive, expensive cloud servers to process AI tasks, they are designing architectures that dynamically pull parameters from the phone's local flash storage.
Right. They're treating the device's storage drive as an extension of the AI model's working memory,
which dramatically reduces their reliance on scarce data center compute. They are advancing the frontier of local inference making, the AI run directly on the device along the cheaper NAND storage access.
By doing this, they abstract away the underlying model, allowing developers to move seamlessly between local AI and cloud AI without massive infrastructure costs.
I have to push back on the broader narrative here, though. Contrast that U.S. technology sell-off with the Asian session. The Kospi surged 8.2% overnight.
Right, Samsung was up 9%, and SK Hynix jumped a massive 16%.
This was driven by aggressive AI dip buying and a huge beat in China AI hardware exports, which jumped 111% year over year.
Yeah, our ETF desk noted $450 million in DRAM memory inflows overnight, adding to $2.5 billion in inflows last week.
So, if Asian markets are aggressively dip buying AI memory chips and China is exporting record volumes of hardware, why is a major US infrastructure player like Supermicro Computer crashing? How do you explain that disconnect?
That tension comes entirely down to the convexity of the AI trade. Convexity in this context means the outcomes are nonlinear.
Right.
When the momentum is positive, institutional flows create extraordinary upside, like a rubber band stretching further and further.
But when sentiment turns, that same leverage triggers violent deleveraging and the rubber band snaps back aggressively.
Exactly. There's roughly $100 billion of leveraged exposure globally across semiconductor and hardware-linked equities right now.
And Supermicro is caught in the harsh reality of a $1 trillion annualized private sector AI capital expenditure cycle. The market is suddenly and increasingly concerned about the actual return on investment for all this spending.
So companies are buying the hardware, but investors are questioning if they will actually make money using it.
Exactly. Our daily desk data highlights a recent Wharton paper showing the productivity gains required to justify today's AI spending are historically extreme.
Meaning the implied financial outcomes needed to validate these valuations exceed what was achieved during the peak of the 1990s IT boom.
Yeah, investors are realizing this, and they are punishing U.S. companies that require massive dilutive capital raises just to participate in the cycle.
The Asian chip makers are basically selling the picks and shovels, while the U.S. hardware integrators are taking on immense balance sheet risk to build the mines.
We are also seeing the Silicon Data Token Spending Index soften modestly. If corporations believe AI computing costs will be significantly lower a year from now, the rational business behavior is to defer spending today.
And that deferred spending directly threatens the massive multiple currently assigned to U.S. AI equities.
We must also acknowledge where the capital is flowing as it leaves technology. Today is day 2 of our 47th annual Global Healthcare Conference.
Right. Regeneron, ticker RUGN, and Neurocrine Biosciences, ticker NBIX, both saw significant institutional demand today.
Capital is actively flowing out of high beta AI momentum names and finding a stable home in healthcare, consumer staples, and industrials.
Indeed. And those physical supply chain constraints we see in AI hardware are directly mirrored in the constraints within the physical commodities market.
Looking at energy, WTI crude closed at $89.25 a barrel, down roughly 2% for the primary session, while Brent closed at $92.34.
Natural gas also fell 2%.
The volatility in the energy sector today was extreme. Oil initially dropped below $90 a barrel due to comments from Donald Trump regarding peace talks with Iran being in their final throes.
Because markets price in forward expectations, right?
Yeah.
So the prospect of peace immediately removes the risk premium from oil prices.
Yeah, and this downward pressure was then compounded by Energy Information Administration data indicating a 1 million barrel per day drop in global demand.
A drop of that magnitude signals significant demand destruction, meaning the high interest rates we discussed earlier are actually slowing down industrial consumption.
But then the session ended with a severe geopolitical catalyst that completely reversed that narrative.
In after-hours trading, WTI jumped roughly 2%, surging back toward the $90 mark.
This followed confirmation from U.S. Central Command of retaliatory airstrikes on 5 locations in southern Iran, including Sirak, Jask, and Bandar Abbas.
Right. This was a response to the downing of an Apache helicopter. Crucially for the physical oil market, our daily desk data confirms Iranian state media reported no commercial ports were hit, which is what ultimately capped the after-hours price spike.
Shifting to metals, copper is heavily supported right now at over $13,500 a metric ton.
This ties directly back to our earlier discussion on the China AI hardware export boom and the massive 210 megawatt AI campus leases we are seeing from companies like Applied Digital, ticker APLD.
You simply cannot build these massive data centers and upgrade the necessary grid infrastructure without immense amounts of physical copper.
Silver also remains elevated at $65.36 an ounce due to its dual role. It has both monetary demand as a store of value and industrial demand for electronics.
And gold also remains extremely elevated, closing at $4,260 an ounce.
Gold's persistent elevation is highly communicative for you as an investor. It is aggressively pricing in 2 distinct, powerful forces simultaneously.
Sticky, persistent inflation eroding purchasing power.
And a sustained geopolitical risk premium.
Yeah, the oil market is currently trapped in an unsustainable equilibrium. The physical market is heavy today despite the negative headlines, primarily because cargoes are still moving freely through the Strait of Hormuz.
But if that conflict escalates, and shipping through that critical strait is severely restricted, physical availability will immediately flash warning signs.
Right, a bottleneck in global energy supply pushes fuel prices up, which pushes global inflation even higher.
That feeds directly back into the hawkish rate expectations and the growth rates tango we analyzed in the first block.
On that point, we must connect the dots across all these asset classes to accurately define the broader market regime for your portfolio.
We have technology equities bleeding violently, we have the options market actively expecting rate hikes, and we have physical commodities remaining structurally elevated.
But look at the credit markets. Our latest run shows high-yield bond ETFs, specifically HYG and JNK, actually closed marginally positive today.
What does this specific divergence in the credit market suggest about the broader economy? High-yield corporate bonds, often called junk bonds, are highly sensitive to default risk.
Especially those lower down the rating scale, like the triple C tranches. If the underlying economy were truly failing and companies were unable to service their debt, the value of these credit assets would drop severely as default expectations spiked.
Instead, their positive close indicates we are firmly entrenched in a higher for longer stagflationary regime.
Yeah, economic growth remains robust, supported by strong consumer spending and continued industrial expansion, but the cost of capital is staying persistently high.
BNY Chief Investment Officer Jason Granite warned today that inflation will stay elevated for longer, pushing rates higher and weighing on bonds structurally.
Consider a simple analogy for the current market environment. The market right now is like a crowded theater.
The mega-cap technology and AI investors all rushed the exit at the exact same time today, causing a panic stampede at the doors.
Right, that stampede accounts for the severe intraday equity swings in the Nasdaq and the volatility index, the VIX, jumping 5% to nearly 20.
However, the credit investors are still sitting calmly in their seats in that exact same theater.
They are just watching the screen because they know the building isn't actually on fire.
The fundamental components of the investment economy, corporate balance sheets, consumer spending, and broad industrial growth remain firmly intact. The panic you are seeing is entirely isolated to stretched valuations in one specific, highly crowded sector.
To recap our core takeaways from today's data, the AI rotation is painful but contained primarily to high multiple technology stocks, with the broader market actually showing positive breadth and healthy rotation.
Treasury yields are reflecting short-term tactical fear, but they mask a long-term structural hawkishness ahead of tomorrow's critical CPI print.
Oil remains highly sensitive to geopolitical headlines, swinging violently on supply shock fears.
And crucially, credit markets confirm the underlying economy is fundamentally sound.
We will leave you with a final thought based on the Apple developer event data in our proprietary updates.
We discuss how Apple is pushing local inference running AI directly on your phone's flash storage.
If AI computing costs compress significantly because advanced models can run locally on device storage rather than relying on massive cloud data centers, will the corporate rush to spend billions on data center hardware suddenly pause?
And if that spending pauses, does it permanently destroy the current massive multiple on the AI infrastructure trade?
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.